This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Shake it off. Stocks stage a comeback, but don't get too comfortable. The biggest issue facing the market hasn't gone away.
The great rate debate. Why are bond yields moving lower when the Fed is pushing interest rates higher?
Big disconnect. Auto stocks stall even as sales soar. Why? And what's next for the car companies? All of that and more tonight on Nightly Business Report for Thursday, January 14th.
Good evening, everyone, and welcome. We assume you didn't win the lottery. A rare thing happened on Wall Street today. Stocks rallied. That hasn't happened much this year. Oil prices stabilized. That hasn't happened much either. J.P. Morgan issued upbeat results, and the optimism got investors buying. By the close, the Dow Jones Industrial Average rose 227 points to 16,379. It had been up more than 300 at one point. The Nasdaq gained 88. The S&P 500 reclaimed the key 1900 level, rising 31. Bob Pisani now with more on today's comeback and why investors shouldn't breathe easy just yet.
The joke on trading desks all week is that Wall Street has been selling stocks to play the lottery. And now that it's over, the market's rallied. That's a good joke, but we rallied today for several good reasons. First, J.P. Morgan had a strong earnings report pre-open. Futures did rise after that report came out. Second, oil staged a sharp rally right after stocks opened. And finally, and perhaps most importantly, St. Louis Fed President James Bullard said this morning that the continuing drop in oil had caused a worrisome drop in inflation that may make further rate hikes hard to justify. Hey, that is a very big statement because Bullard is a centrist and a voter on the FOMC this year. So is this the bottom? I don't think so. First, we're still dealing with the biggest issue of all. Just how much is the global economy decelerating? Second, oil has not clearly bottomed. And also, it's not clear the Fed is going to back off its aggressive rate hike policy. Finally, remember, we haven't dropped that much. Right now, we're in the middle of a garden variety correction. That's right, the S&P 500 is only off 10% from its historic high it hit in the middle of last year. But remember, the S&P went from 700 in 2009 to 2100 in 2015. Now it's only at about 1900. So we're going to rally for 7 years and then we just get a garden variety 10% correction? It just doesn't seem like that's enough. That's why the rally seems kind of tentative. No one is going all in because there is still too much downside risk. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
As Bob just reported, the global slowdown is perhaps the biggest issue facing the market. But how does an economic contraction spread from one country to another and then across the globe? Dominic Chu breaks it down.
Given all of the market turmoil, there's a lot of conversation, there's a lot of talk about a possible financial contagion. So let's take you through what exactly a financial contagion would be. Now, it depends on who you ask, but the general concepts are there. First of all, in a financial contagion, you're talking about the start of it being very localized, meaning it's one geographic area or it's one particular asset class, one economy, that sort of thing. From there, that ripple effect, it spreads. All the downside spreads to other parts, neighboring geographies, other different asset classes, that sort of thing. So you get this kind of spread like a disease. Also, it leads to widespread financial distress. Now, what we mean there is possibly huge amounts of selling, perhaps forced selling at some point with people trying to raise money, trying to take their risk off the table, trying to lock in some of those cash profits that they have or avoid losses. Those three general concepts. Now, we've seen a couple examples in recent memory of this happening. First of all, what happened in Thailand, 1997, the Asian financial crisis. It started off as a currency issue, a devaluation in Thailand. It spread throughout Southeast Asia, hit parts of Europe, led to possibly what happened in Russia with the financial crisis there. And then it just spread all over and it affected our markets as well. Also, what happened in the subprime mortgage crisis back in 2007, 2008, that spread as well. The big concern and why people are talking about it these days is China. Will that economic slowdown lead to another possible contagion? That's the big question. For Nightly Business Report, I'm Dominic Chu.
Meanwhile, here at home, the number of Americans filing for first-time unemployment benefits climbed last week, but they remain at a level consistent with a healthy labor market. Initial claims did rise 7,000 to 284,000, making this the 45th consecutive week below 300,000. That's the longest such stretch since the early 1970s.
And the strengthening job market is one of the reasons why the Federal Reserve raised interest rates at its meeting last month. But instead of going higher, key interest rates have fallen. And that's creating a disconnect between the Fed and the market. Steve Leisman takes a look at which side may blink first.
Markets have been telling the Fed they were wrong about inflation, the economy, and hiking rates. And with a 1,000-point drop in the Dow, they were practically screaming it. The Fed may finally be hearing it. St. Louis Fed President Jim Bullard became the third Fed official in 2 days to hint the Fed may be less aggressive in raising interest rates this year. Quote, "I'm starting to wonder if my story is the right one," Bullard said about his forecast that oil would stop dropping and inflation would pick up this year. Bullard now says the oil decline is substantial and could mean a slower rebound in inflation than he forecast, and that could mean fewer rate hikes. Other Fed officials in recent days have said risks to the U.S. are rising due to weakness in key economies like China. It's making the market believe the Fed's forecast for 4 rate hikes is looking at best like a long shot.
The Fed is reacting to a couple of things. One, the drop in oil, the drop in import prices, putting more downward pressure on realized inflation. The drop in inflation expectations that are now back down to the lows we saw in September. And finally, they're reacting to the volatility we're seeing overseas, the uncertainty about China. All of that adds up, to my mind, to a lower chance of a March hike and probably a fewer number of rate rises than they were suggesting at the end of 2015.
Since the rate hike, markets and the Fed have been out of sync. For example, the 10-year note, a key interest rate for the economy on which mortgages are based, has fallen enough to remove a big part of the Fed's quarter-point hike. Of course, a reversal in oil prices and stabilizing world economies could put rate hikes back on the table. But for now, in the debate between markets and the Fed, score 1 for the markets, even though it had to scream to make its point. For Nightly Business Report, I'm Steve Leisman.
Scott Miner joins us now to talk more about what lies ahead for the U.S. stock market and other markets. He's Chief Investment Officer with Guggenheim Partners. Scott, always great to see you. Let's take today's little rally off the table for a moment. So far in 2016, stocks have been sliding, but there has not been a washout. Does the fact that there hasn't been that level of panic or washout concern you and suggest that we may have farther to fall before a bottom is put in?
Well, Tyler, you're hitting the nail on the head in my mind. You know, we've not seen a spike in volatility in the volatility index at the S&P. Volatility, typically that index gets into the 30s before we see a bottom. We haven't cracked 30 at all in this process. The other thing, too, Tyler, is that bottoms are marked by huge increases in volume. And this has been a very light volume move in terms of just relative to average volume days. Most days are just average. So until I see some level of fear and panic in the market, I just can't believe that we're anywhere near a bottom for the time being.
Longer term, I know you're optimistic, but if we're not near a bottom right now, by your measurements and your analysis, how much further do you think this market has to go?
Well, Sue, you know, obviously 1850 around the S&P, which we're very near to, is a key level to hold if we're not going to go down. But if that level breaks, then I expect we probably have at least another 10 to 15 percentage points down before we find some stability in U.S. stocks.
Would that mean the end of the bull market or just a correction in it?
Well, technically, Tyler, you know, from where we sit today or where we were at the peak, another 10 to 15% is going to be officially a bear market.
Right.
But I like to remind people, you know, we had periods like this in the past. 1987, 1994, 1997, which was the Asian crisis. And all of those markets these sell-offs were completely disconnected from the economy. The economy remained strong throughout, and ultimately, people who bought stocks in those sell-offs did very, very well. And I think this is a time where contagion and events in China are spilling over into the financial markets, but they're not affecting the real economy. And at the end of the day, the real economy will win.
How much of this is dependent in a stabilization and a move perhaps higher in the oil market, Scott?
Well, Sue, I think the energy story is getting pretty much played out at this point. I think we still have some downside room. You know, I wouldn't be surprised to see $25 oil. But the bottom line is that markets are largely pricing for this now. Mm-hmm. I think the real story is China. What's happening with the RMB? For the last 2 nights in Hong Kong, overnight rates had to increase to levels of 30 to 60% to stabilize the currency. Obviously, markets win in the end, and the government's attempts to maintain the exchange value will have to give way. And I think the turbulence that come out of that once we get a crack in those markets will give us a sign that maybe that's the bottom and time to get in.
We have to leave it there, Scott, but these are lessons Beijing is learning the hard way, right?
You are, and the markets always win, Tyler.
Right. Scott Minerd with Guggenheim Partners. Thanks again.
The global slowdown and the collapse in commodity prices is triggering bankruptcy concerns, not just in the oil industry, but across the commodities sector. Most recently, Arch Coal, the second largest coal producer in the country, filed for Chapter 11 reorganization. So if you're a shareholder, what are the warning signs that a company might soon go into bankruptcy? Michelle Caruso-Cabrera takes a look.
The history of Wall Street is littered with the charts of commodity companies like this one that have tremendous rallies when commodities are smoking hot and then plummet along with the underlying commodity when things go bad. Arch Coal went from $744 just a few years ago to being virtually worthless. If you were to do an autopsy, a financial autopsy, say, of Arch Coal's bankruptcy, you would find that there were clues for stock investors that maybe they should have gotten out. The key thing with any commodity company right now is you want to look not at how the stock is trading, but how is their debt trading. If you look at Arch Coal, they had a note that was due in 2021. It was a 10-year note, $1 billion worth of debt. At the time they issued it, the yield was 7.25%, already high, already suggesting risk. But it traded at par for a couple of years. Then in January of 2014, the price falls to 78 cents on the dollar, yield rising to 11.77%. 9 months later, the price of the debt falls to 53 cents on the dollar, 20% yield. Now in bankruptcy, it is worth virtually nothing. If you talk to bankruptcy attorneys, they say, listen, there's a big warning sign for commodity companies. If the vast majority of their debt is trading somewhere between 50 and 70 cents on the dollar, that is a problem. And here's why. That suggests the company is distressed. If it goes into bankruptcy, gets restructured, the debt holders get satisfied before the stockholders. What often happens is there's nothing left. What they say to the debt holders is, they say, listen, we can't pay you. So what we're going to do is we're going to make a new company, and we're going to give you equity in that new company. And the guys who had the equity in the old company, they're going to get zero. Debt becomes equity, and equity, the current equity, often becomes zero. If you're invested in smaller exploration production companies or other kinds of commodity companies, you want to take a look at how the debt is trading. For Nightly Business Report, Michelle Caruso-Cabrera.
And still ahead, driving in reverse. Auto sales are soaring to record levels, so why are auto stocks going in the opposite direction?
Intel reporting better than expected earnings after the closing bell, but investors focused on a decline in gross margins. The Dow component earned 74 cents per share, beating Wall Street's 63-cent estimate. Revenue was slightly better and up marginally from a year ago, but gross margins declined, pressuring shares initially in after-hours trading. In the regular session, shares rose. But its PC business is also a big concern. And as Josh Lipton reports, Intel has a strategy to overcome it.
Research firm IDC reports that PC shipments fell 11% in the fourth quarter, the largest year-over-year drop in the industry's history. The market is under pressure from the popularity of mobile devices such as smartphones and tablets, and that is bad news for Intel.
They derive 2/3 of their revenue from the PC market, which contributes about half of the company's profit. Management is tasked with growing bottom line profits, which is a challenge when your PC market is not in growth mode, which it hasn't been for several years.
But Intel's CEO, Brian Krzanich, is well aware of this trend, which is why he's looking to diversify Intel's business. In addition to PCs, he's focused on selling chips for data centers, which handle the workloads of mobile apps. For example, when users open the Facebook app on their smartphones, it's probably Intel providing the processing power that displays all those videos. Financial analysts like Friedman are betting on continued growth in the data center business.
We expect that next year it actually can contribute more than half of the company's profits as data centers growing at least double digits, and we're calling for a 15 to 16% growth year.
But there are risks for this business, namely whether cloud giants like Amazon and Microsoft could use their leverage to demand cheaper prices for Intel's data center chips. But Krzanich dismisses that concern.
Always make sure you take care of those customers and please them as much as you need to keep them coming back. Secondly is keep driving technology such that people have to go, they want to go buy your parts. There's a need for the performance that you're going to provide.
And Krzanich is putting his money where his mouth is. Intel recently completed a $17 billion acquisition of Altera. That could provide the company with more specialized chips for the data centers of the future and help to offset some of the pressure in the PC market. For Nightly Business Report, I'm Josh Lipton in San Francisco.
Fellow Dow component JP Morgan topped earnings and revenue expectations. The biggest U.S. bank was helped by cost cuts and lower legal expenses, and that helped send shares higher today. Kayla Tausche now with more on what went right for JP Morgan.
Expectations for bank earnings may not have been high, but JP Morgan still blew them out of the water. The bank posted record full-year profit and beat fourth quarter estimates handily. The bank, the largest in the U.S. by assets, saw mixed performance across its four business units. Loan growth in consumer and commercial banking did help, slower growth in investment banking, and outflows in asset management.
The offense wasn't great, but we'll take flat revenues in an environment like this. But JP Morgan beat expectations on defense. Lower expenses, lower assets.
It did spend more than $1 billion to cover loans that could go bad. That was a lower amount than analysts expected, but only about a tenth of that total went to cover companies in the oil, gas, metals, and mining sector. As the price of oil and other commodities keeps sinking, it makes the companies in that sector less profitable, makes their debts harder to pay. Analysts asked the bank's CEO, Jamie Dimon, whether a year from now he'd look back and realize they'd underestimated that problem.
We try to be very conservative always, and so we're not trying to put up as little as possible. Me, I'd put up more if I could, but accounting rules dictate what you can do. And these are baskets of, the real risk is in producing wells, cash flows are down. Surprisingly, the cost of getting the oil out of the ground has also dropped dramatically.
That optimism aside, investors have been selling financial shares. JP Morgan stock down 11% this year, despite rising 2% after earnings. But RBC's Gerard Cassidy said there's still growth around the corner, especially if the Fed raises rates again. The banks could earn higher yields on their loans while keeping payouts on deposits low. That's bad news for consumers who want to earn more on their savings, but it's music to the ears of shareholders. For Nightly Business Report, I'm Kayla Tausche in New York.
Best Buy lowers its sales outlook, and that is where we begin tonight's market focus. The nation's largest consumer electronics chain says it expects sales to fall about 1.5% in the current quarter. This follows weak demand for mobile phones during the holiday season. It sent shares 9% lower to 26.43. Goldman Sachs reportedly plans to cut up to 10% of its sales and fixed income trading jobs. Every year, the firm sheds about 5% of its total workforce in March to make room for new hires. Separately, the bank reached a $5 billion settlement with regulators over the sale of mortgage-backed securities. Shares of Goldman rose 1.5% to $161.39.
Rio Tinto is freezing the salaries of all of its employees, including the CEO, as the prolonged slump in commodity prices takes its toll on the company. The world's second largest miner also warned it sees no end in sight for the rout in commodity prices. Nevertheless, shares of Rio Tinto rallied nearly 6% today to $25.20. Shares of Fiat Chrysler under pressure after two dealerships accused the automaker of inflating sales numbers. The dealers, which are part of the same auto group, filed a civil lawsuit saying that Fiat Chrysler paid dealers to falsify sales figures to, quote, create the appearance that Fiat Chrysler's performance is better than, in reality, it actually is, end quote. For its part, Fiat Chrysler says the allegations are baseless and strongly rejects the accusations. Shares of the company, though, off today 4% to $7.53.
Auto sales set a record last year with 17.5 million vehicles sold. But those strong numbers have not helped the car makers' sagging stock prices. Over the last 12 months, shares of GM are down 12%, Ford off 19%, and Chrysler down 37%. Colin Langan joins us now to discuss the disconnect between auto sales and auto stocks. He's an auto analyst at UBS. Colin, welcome. Nice to have you here.
Thanks for having me on.
Why is there that disconnect?
I mean, I think when we're looking at it, people, as sales have increased, people are starting to worry about peak U.S. SAR, and that's a concern for the cycle. I think, in my opinion, I think we still have some room to grow, and I think valuations here are very compelling for both GM and Ford.
But GM stock has been pretty much stuck in neutral since it came back onto the market 4 or 5 years ago, right, Colin? Why hasn't, I take your point that maybe people are concerned that sales here in the U.S. are peaking, but the stock really didn't run up at all, even as stocks were rising.
Yeah,
sales were rising, I should say.
Well, I think you have to realize these are global companies. So, coming out of the IPO, things look pretty good. But then we had Europe collapse, you had South America collapse, you had Asia ex-China collapse. And so they really had a lot of hurdles because there's a very high fixed cost business. I think as you look at where they are today, they've massively restructured the business. They've taken some pretty aggressive actions. And so one of the actually tailwinds going forward is actually the profits or the actually losses in those regions are going to turn, toward profits. And so that's actually going to be one of the lifts over the next few years, in addition to continued improvements in the U.S. They've done a massive restructuring there, and we're seeing the benefits of that today.
You also think there's a tailwind from the downfall in commodity prices because they are net consumers of commodities.
Yeah, absolutely. I think that's one of the biggest things investors are missing about these stocks is this is going to be a huge margin lift. We're talking hundreds of millions of dollars. We estimate it's almost $500 per car is the decline in raw material costs. So this is a huge support for these names and really should drive some upside to earnings going forward that people aren't expecting and should get valuations back to where they should be.
So you like Ford and GM. You don't cover Fiat Chrysler, but you really like a couple of the auto suppliers, Borg-Warner and Johnson.
Yeah, and we have buy ratings on both of those names. I think there's definitely some good opportunities among the supply space, particularly after the correction we've seen over the last week or so.
All right, Colin, we'll leave it there. Thanks for joining us. Colin Langan with UBS. Coming up, from juice bars to spin classes, a look at the big money behind the business of getting fit. We are 2 weeks into the new year. Have you kept your resolution? Many of us focus on health, vowing to eat right and work out. And as Morgan Brennan tells us, there's a lot of money behind the pursuit of healthy living.
Nice, guys. Thumping music, mood lighting, celebrity trainers, and an average price tag of $30 per class.
Here we go.
Boutique fitness, the new way to work out. And in cities across the U.S., business is booming. The International Health, Racquet, and Sports Club Association says growth in health club memberships has been outpacing growth in the U.S. population, driven largely by boutique studios. 42% of all members used these facilities in 2014, up dramatically from just 22% the year before. Best known, perhaps, is SoulCycle, the indoor cycling company with a cult following and plans to go public this year. But it isn't alone. Competitor Flywheel has nearly 36 studios where customers take choreographed spin workouts and compete on performance.
A premium on a great experience in a short amount of time, an immersive workout experience with highly trained instructors and great music.
Barry's boot camp, which combines running and circuit training, claims 21 outposts. Armed with Wall Street funding, it also has aggressive expansion plans.
We have a pretty exciting trajectory ahead of us. I know that we want to get to at least 50 stores over the next 5 years.
The studio model price points are 50 to 100% higher than the industry average. As fitness flourishes, it's even inspired a fashion trend called athleisure, stretchy yoga pants and $100 hoodies that can be worn to break a sweat or socialize with friends. While 2015 was a rocky year for apparel, analysts say this segment outperformed.
Active apparel business was up in the mid-teens, and the active footwear business was up in the mid-single digits.
Bandier touts more than 40 fitness brands and a celebrity following. Since launching in 2014, the fashion startup has opened 5 brick-and-mortar locations, including this brand new 3-story Fifth Avenue flagship, which even has a studio where well-known instructors will teach classes.
It's also helped fuel a culinary craze. While food sales were flat in 2014, Nielsen says foods labeled with health attributes like gluten-free, organic, and GMO-free jumped 13%, meaning getting in shape may increasingly mean getting financially fit. For Nightly Business Report, I'm Morgan Brennan in New York City.
And finally tonight, 3 winning tickets hit the $1.5 billion Powerball jackpot last night. The tickets were sold in Melbourne Beach, Florida, Munford, Tennessee, and at a 7-Eleven in Chino Hills, California, where the clerk became an instant celebrity. There he is when people showed up to celebrate the lucky sale. As for the winners, no one has come forward yet. I think the first number they drew was 8.
8.
It was on none of my
none of mine
none
either.
of mine, so I could throw it out right away.
I did, and then I went to bed.
Yep.
That does it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
And I'm Tyler Mathisen. Thanks for me as well. Have a great evening, everybody, and we'll see you here tomorrow night.